Bismillahirrahmanirrahim. In the previous class, we discussed about dividends and dividend policy. Before that, we discussed about lease. Today, we are going to start new chapter, and chapter name is Financial Markets. In this chapter, the topics that we will discuss, that what is financial market, flow of funds through financial system, how funds are flowing or moving in a financial system, direct finance and indirect finance, financial intermediaries, and functions of financial intermediaries. In this, there are two very important topics: asymmetric information, adverse selection, and moral hazard. So we will discuss about all these. First of all, what is a financial market? A financial market is a market in which financial assets, securities, bonds, shares, bonds and its types, shares and its types can be purchased or sold. So any market in which financial assets can be purchased or sold is called financial market. Markets for sale and purchase of stocks, that is shares, bonds, bill of exchange, futures and options, foreign currency, etc. All these are coming in financial assets. These are basically financial assets. So a market in which all these things are traded, we call it financial market. Financial market facilitate transfer of funds from person or business without investment opportunities. Those people who don't have investment opportunities. So funds are transferred from them. We call them lender savers. Or we call it surplus unit. Those people who have extra amount, who have surplus amount of money. Or you can say lenders, those people who don't have investment opportunities. To those who have investment opportunities. So funds are moving from those people who don't have investment opportunities to those who have investment opportunities, like we call them borrowers, spenders, or deficit unit. Like you can say these are lenders, and these are borrowers. So funds are moving, financial market is a market in which funds are moving from lenders to borrowers. Simple as that. Are those people who have surplus money. To those people who have deficit of money. Or simply you can say those who don't have investment opportunities. To those who have investment opportunities. So financial market is a medium between these two, lenders and borrowers. Simply. Any means by which funds are moving from lenders to borrowers. Any mean we call it financial market. So financial market facilitate transfer of funds from person or business without investment opportunities. We call them lender savers or surplus unit, to those who have investment opportunities. We call it borrower spenders or deficit unit. Simply you can say here general public and businesses who have surplus funds. General public and businesses, but businesses those who don't have investment opportunities and they have surplus money. So they are giving that money to those business units who have investment opportunities and they are in a situation of deficit, means they don't have money. So this is basically financial market. Now see here the flow of funds. This is financial intermediaries. Here is indirect finance. This is direct finance. Indirect finance, lender savers. Lender savers can be household, individuals, families, business firms, government, foreigners. So all these people, they have surplus money. So they are giving these funds through financial markets directly to borrower spenders, business firms, government, household, foreigners. But they are giving this money directly to them. They are buying bonds, or they are buying shares directly in the financial market. Directly going to financial market, purchasing bonds, purchasing stocks, whatever that is, lending money, giving loans to business firms, to governments, or to households by purchasing T-bills or commercial papers or long-term bonds or shares, preferred stock or common stock, whatever mean it is, but they are directly doing that thing. So funds are flowing in this way. The second way, that is indirect finance. Funds are moving here to financial intermediaries. You people studied in investment that what is financial intermediary. These financial intermediaries, they are issuing shares which these people are purchasing these shares. The money, the funds that they are getting, they are purchasing bonds and stocks of different other firms, whether national firms or international firms. So they are taking funds from household, from business firms, from governments or foreigners, and then they are investing it in a portfolio. They are purchasing bonds and shares of other companies. Here it is direct. See, these household business firms, they are purchasing bonds and stocks of these firms directly in the financial markets. But here what is happening? They are issuing shares or bonds. These people are purchasing these bonds and shares. Then they are purchasing bonds and shares in the stock market indirectly, not directly. See, in the middle, these people are involved. They are issuing shares to these. When they got money, then they are investing it in bonds and shares of other companies. So this is called indirect finance. So one is direct finance, in which individual, businesses, government, foreigners, they are directly purchasing bonds and shares in the financial market. And the other one is indirect finance, in which these financial intermediaries are investment firms. They are issuing bonds and shares. The money, mostly they are issuing shares. The money that they are getting, they are investing it in bonds and shares of other companies, or they are investing it in a portfolio. So this is flow of funds in financial market. So one is direct and the other one is indirect finance. Direct finance is through trading securities, financial instruments in financial market. Directly you are going and you are purchasing bonds and shares. Indirect finance, transfer firms via financial intermediaries. You are purchasing shares of financial intermediaries. Then these financial intermediaries, they are doing financial asset transformation. What is financial asset transformation? It is coming, then we will discuss this. So financial asset transformation. What is financial asset transformation? So financial intermediaries, they are involved in financial asset transformation. So what is financial asset transformation? FAT means to purchase one kind of financial assets from borrowers, long-term loan contract or whatever, and sell a different kind of financial assets to savers, generally relatively liquid contract. So simply what this means is that financial intermediary, these are financial intermediary, they are purchasing one type of asset from the lenders. These are lenders, suppose these are individuals. They are giving them short-term loans, or they are purchasing shares of these financial intermediaries. So this is one type of asset. Then financial intermediaries, they are purchasing, suppose they are purchasing bonds of other companies. See, they are issuing shares. So asset is in one type. And then they are purchasing what? Bonds. So bond is different, share is different. Are these financial intermediaries, suppose they are taking loan from a bank. They are purchasing what? They are taking what? Loan from a bank. So they took loan from bank, and then on that loan they are purchasing shares, or they are purchasing bonds of different companies. Or they are doing what? Real estate business. Real estate mean land, buildings, these, the purchase and sale of land and building and these things. So see, they are taking loans in one form and then they are converting these to other forms, to bonds or to shares or to real estate assets or whatever that is. So this is financial asset transformation. They are taking money in one form and then they are converting it to other form. This is called financial asset transformation. So see, means to purchase one kind of financial asset from borrowers, long-term loan contract, or it can be, you can say, shares, and sell a different kind of financial assets to savers, generally relatively liquid contracts. Financial intermediaries make profits from financial asset transformation, and they are making profit on the base of financial asset transformation. Now, structure of financial market. One is debt and equity markets. A firm or individual can obtain funds in financial market in two ways. The most common method is to issue a debt instrument, such as bond or mortgage, which is a contract agreement by borrower to pay the holder of instrument fixed dollars amount at regular intervals until a specified date when a final payment is made. Now you know about this thing. I'm not going to go in detail of this thing. The maturity of debt instrument is the number of years until that instrument's expiration date. You know about all these things. A debt instrument is a short term if its maturity is less than 1 year, and long term if its maturity is 10 years or longer. And between them, it will be medium term. Long term, more than 10 years. Short term, less than 1 year. And medium term, 1 to 10 years. Debt instrument with a maturity between 1 and 10 years are said to be intermediate term. The second method of raising funds is by issuing equities, such as common stock, which are claims to share in the net income. So you know about the equities, that equity is a claim on the assets of the company. I'm not going in detail of this thing. You know about debt and equity. Then primary and secondary market. A primary market is a financial market in which new issues of security, such as bonds or stocks, are sold to initial buyers by the corporations or government agency. So a primary market is a market in which first-hand securities are bought and sold. First time when securities are traded, we call it primary market. We discussed about this. You know about investment banker, how investment banker is facilitating the issue of shares and bonds. So that is basically primary market. Secondary market is a financial market in which securities that have been previously issued can be resold. Stock exchange is an example of secondary market in which already issued securities are bought and sold. Exchanges and over-the-counter market. Secondary markets can be organized in two ways. One method is to organize exchanges where buyers and sellers of securities or their agents or brokers meet in one certain central location to conduct trade. If for trading bonds and shares there is a central location, we call that exchange market or exchanges. New York and American Stock Exchange for stocks and Chicago Board of Trade for commodities, wheat, corn, silver, and other raw materials are examples of organized exchanges. So that market in which buyers and sellers come together and they are buying and selling shares or bonds or commodities, wheat, corn, silver, we call it organized exchanges. So organized exchanges is what? Is a market which have a central physical location. In that physical location, buyers and traders are coming together and trade took place between buyers and sellers. So we call it organized exchanges. The other type of market is called an OTC market, over the counter market. The other method of organizing a secondary market is to have an over the counter market, in which dealers have at different locations who have an inventory of securities stay ready to buy and sell securities over the counter to anyone who comes to them and is willing to accept their prices. This market don't have a physical location. On computerized systems, buyers and sellers, they are making trades. There is no central physical location, I'm telling you. On telephone, on emails, or on computerized databases, shares and bonds are bought and sold. So that type of market is called over the counter. Because over the counter dealers are in computer contact and know the prices set by one another, the OTC market is very competitive and not very different from a market with an organized exchange. And keep in mind, this is also very competitive market. But the disadvantage is that in this market, if there is a trade between two parties, if there is a trade between two parties, A and B, no one else will be aware of that. But in organized exchanges, if there is a trade between A and B, this is not hidden. Each and every person will be aware from this. But on computerized exchanges, on over-the-counter market, if there is trade between these two parties, no one else will be aware. C will not be aware. But here, since it is open outcry, just like bidding, so each and every person in the market will be aware that A purchased this share or bond or commodity from B for $17 or for $18, whatever that is. So this is the difference between these two. OTC market and organized exchanges. This have a central physical location. Here there is no central physical location. Computerized databases. Here, if there is a trade between A and B, each and every person will be aware of the price. But here, if there is a trade between A and B, nobody else will be aware of this. So this is the difference between OTC and organized exchanges. Money and capital markets. Another way of distinguishing between markets is on the basis of maturity of the securities traded in each market. You can also distinguish financial markets on the basis of money and capital market, on the basis of maturity of securities. If the maturity of securities is less than 1 year, we call it money market. And if the maturity of securities is more than 1 year, we call it capital market. The money market is a financial market in which only short-term debt instruments, generally those with original maturity of less than 1 year, are traded. Those securities whose maturity is less than 1 year, they will be traded. The capital market is the market in which long-term debt or long-term equity, generally with original maturity of 1 year or greater, and equity instruments are traded. So, long-term debt instruments and equity instruments are traded in capital market. So, money market is short-term market, and those securities whose maturity is less than 1 year, and in capital market, those securities whose maturity is more than 1 year are traded. Financial intermediary. Financial intermediary is a special financial entity. It is a financial entity. It is a financial institution, you can say, or financial entity, which performs the role of efficient allocation of funds. When there are conditions that make it difficult for lenders or investors of funds to deal directly with borrowers of funds in financial markets. Basically, there are some conditions. Because of these conditions make it impossible for lenders and borrowers to make a trade. When there are conditions that make it difficult for lenders or investors of funds to deal directly with borrowers. Because of these difficulties, it is difficult for lenders or investors of funds to deal with the borrowers of funds in financial markets. So because of these difficulties, there are financial intermediaries who are removing these difficulties. What are these difficulties? It is coming, so we will discuss it one by one. Financial intermediaries include depository institutions. You know depository institution, banks, insurance companies. It can be insurance companies, investment banks. It can be investment banks, and it can be pension funds. You know about investment banks, we already studied about this. And pension funds, you people call it taqawut. So there are some pension funds who are involved in doing like financial intermediaries, in providing services of financial intermediaries. Now, what are the functions of financial intermediaries? These are basically functions of financial intermediary. The first function is indirect finance, facilitate borrowing and lending. They are facilitating the borrowing and lending. The second is lower transaction cost. Their transaction cost is low. They have economies of scale. They have experts. They give you liquidity services. We'll discuss it in the next class in detail. These are detailed topics. So here just a small introduction. Reduce risk. They are also reducing the risk. Risk of sharing, risk of diversification. Alleviate asymmetric information problem. They are also removing the problem of asymmetric information. So we will discuss these one by one. You know about borrowing and lending. They are working as a middleman, just like we discussed here. These are financial intermediaries. Here are lenders, and here are those people who have investment opportunities. So they are here, financial intermediaries. So they are just like a bridge between these two parties. This party, lender savers, and borrowers spenders. So they are working as an intermediary between lender savers and borrowers spenders. So facilitate borrowing and lending. They are facilitating borrowing and lending. Lower transaction cost. So we will discuss it inshallah in the next class. Assalamu alaikum.